In a recent development, the merger between HDFC Bank and HDFC Limited has raised concerns regarding the impact on equity mutual funds. With a significant number of equity mutual funds having exposure to HDFC Bank shares, the Securities and Exchange Board of India, SEBI, is faced with the challenge of addressing this issue. According to SEBI rules, a mutual fund scheme cannot have more than 10% exposure to a single stock. However, after the merger of HDFC twins, several equity mutual funds will exceed this limit in HDFC Bank shares, including schemes like Invesco India Tax Plan, Bandhan Large Cap Fund, Tata Equity PE Fund, and Sundaram Large Cap Fund. Under the current SEBI rules, equity mutual funds that have more than 10% exposure to HDFC Bank shares after the merger will be required to reduce their stake in the stock to 10% within 30 days. However, experts believe that SEBI may provide a timeline for mutual funds to gradually reduce their exposure instead of requiring immediate selling. This approach is aimed at avoiding an artificial downside in the HDFC Bank share price. The director of wealth at Transcend Capital said, "SEBI rules state that a mutual fund scheme cannot hold more than a 10% stake in a single stock. However, in certain circumstances, SEBI allows for some relaxation. In the case of the HDFC twins merger, SEBI may grant some relaxation by setting a timeline for mutual funds to reduce their exposure in HDFC Bank." The decision to provide a timeline instead of immediate selling is crucial because sometimes the exposure of mutual funds to a stock exceeds 10% due to the appreciation of the stock's value. SEBI typically asks mutual funds to trim their exposure within a given time frame. In this case, the exposure of mutual funds to HDFC Bank has increased due to both the appreciation of HDFC Bank and HDFC Limited share prices and the merger itself. An investment expert mentioned that SEBI needs to consider both scenarios in which mutual funds' exposure exceeds the 10% limit. Asking them to immediately reduce their stake may lead to an artificial downside in HDFC Bank shares, even though the fundamentals of the stock have become stronger after the merger. SEBI should be aware of this and provide a reasonable time frame for the reduction of exposure. On the other hand, it is possible that SEBI may allow mutual funds to continue holding more than a 10% stake in HDFC Bank shares but with certain terms and conditions. SEBI has the authority to relax its rules under specific circumstances. Retail shareholders of HDFC Bank are advised to closely monitor SEBI's next steps regarding mutual funds exposure exceeding the 10% threshold after the merger. The merger between HDFC Bank and HDFC Limited, effective from July 1, 2023, brings together significant synergies and is expected to create value for stakeholders. As per the merger scheme, eligible shareholders of HDFC Limited will receive 42 new equity shares of HDFC Bank for every 25 shares held. The future of HDFC Bank's share price and the mutual fund industry hangs in the balance.